What you need to know before investing in a company. When it comes to investing, there are a lot of factors to consider. But one of the most important is whether or not the company you're investing in is stable. In this video, we'll go over what you need to know before investing in a company, including how to tell if it's stable and what to do if it isn't. What is an investment and what are the different types of investments available to you? When most people think of investments, they think of stocks and bonds. However, there are many different types of investments available to individuals and businesses. Real estate, art, and commodities are just a few examples. Each type of investment has its own risk profile and potential return. For instance, real estate is often considered a more stable investment than stocks, but it also typically has a lower potential return. Art can be a very volatile investment, but it also has the potential to generate high returns if the right piece is purchased. It is important to do your research and understand the different types of investments before you commit any money. Otherwise, you could end up losing everything you invest. How do you research a company before investing in it? Before investing in a company, it is important to do your research to ensure that it is a sound investment. To get started, you can look at the company's financial statements to get an idea of its overall health. You can also read reports from analysts to get their take on the company. In addition, it is a good idea to talk to other investors to see if they have any insights. Finally, you should always consult with a financial advisor to get professional guidance before making any investment decisions. By taking the time to do your research, you can help reduce the risk of losing money on a bad investment. What are the risks associated with investing in a company? When you invest in a company, you are essentially betting that the company will be successful in the future. However, there are always risks associated with this type of investment. For example, the company may not be able to execute its business plan, or it may run into financial difficulties. Additionally, the stock market is always subject to fluctuations, which can impact the value of your investment. While there is no sure way to predict the future of a company, doing your research and diversifying your portfolio can help reduce the risk of losing money on your investment. What are some tips for minimizing those risks? As any business owner knows, there are always risks associated with running a company. Whether it's the risk of financial loss, the risk of legal trouble, or the risk of reputational damage, these risks can have a serious impact on the success of a business. Fortunately, there are some steps that business owners can take to minimize these risks. For example, one way to reduce the financial risk of running a business is to diversify one's income streams. This means having multiple sources of revenue so that if one stream dries up, the others can help keep the business afloat. Additionally, it's important to stay up to date on changes in the legal landscape, as new laws and regulations can introduce new risks. And finally, businesses should make sure they have strong reputation management systems in place so that they can quickly address any negative publicity. By taking these steps, businesses can minimize their exposure to risk and increase their chances of success. How do you sell your shares of stock in a company? When you invest in a company by buying shares of stock, you become a part owner of that company. In some cases, you may decide that you no longer want to own shares in the company, and you may want to sell your shares. There are a few different ways to sell your shares. One way is to contact the company directly and ask to sell your shares. Another way is to contact a broker and ask them to sell your shares on the stock market. If you decide to sell your shares on the stock market, you will need to set a price at which you are willing to sell them. Once your shares are sold, you will receive the money from the sale in your account. You can then use that money to reinvest in another company or withdraw it for personal use. Selling your shares of stock can be a simple and straightforward process, and it can be a great way to generate income from your investments. What are some things to consider when choosing an investment broker? When it comes to choosing an investment broker, there are a few key factors to consider. First and foremost, you'll want to make sure that your broker is licensed and registered with the Securities and Exchange Commission (SEC). This ensures that they are held to the highest standards of ethical conduct and professional competence. Additionally, you'll want to look at the fees they charge for their services. While most brokers charge commissions on the trades they execute, some may also charge monthly or annual fees. Finally, you'll want to consider the type of services your broker offers. Some brokers provide full-service options, which means they can help you with everything from asset allocation to retirement planning. Others offer more limited services, such as online trading platforms. By taking the time to understand your needs and compare different options, you can choose the investment broker that's right for you. Be sure to subscribe to my channel. I'll be uploading new content every week.